A $300 loan that costs $1,500 to pay off. A 391% annual interest rate printed in documents most borrowers can't parse. This is legal. The documents show how it was designed to stay that way.
The payday lending business model depends on rollover. A borrower who takes a $300 loan can't repay it in 2 weeks, pays a $45 fee to extend, and does this repeatedly. The CFPB's 2013 report found that 80% of payday loans were rolled over or renewed within 14 days. The industry's profitability was structurally dependent on borrowers staying in debt, not paying it off.
The disclosure documents used by payday lenders are technically compliant with the Truth in Lending Act. They state the APR, they state the finance charge. The legal review of these documents has found that the fee structure is expressed in ways that minimize the psychological impact of the rate, listing the 2-week fee rather than the annualized rate, using non-standard terminology and placing the APR figure in locations that eye-tracking studies show receive the least attention.
CFPB examination documents, obtained through FOIA requests and enforcement proceedings, showed that major payday lenders had internal analytics on rollover rates and borrower behavior that demonstrated awareness of the debt trap dynamic. One examination finding described a lender that had modeled expected revenue streams assuming the majority of loans would roll over 6 or more times.
The rent-to-bank scheme was the industry's response to state interest rate caps. Payday lenders partnered with nationally chartered banks exempt from state usury laws to originate loans. The bank's name appeared on the loan documents. The payday lender purchased the loan back within days, retaining economic risk while using the bank's charter to avoid state regulation. Internal documents from multiple cases showed that the bank received a small servicing fee, while the payday lender maintained underwriting, marketing, and collections.
The CFPB's 2017 payday rule required ability to repay assessments and limited rollover sequences. The rule was partially rescinded in 2020. In 2023, a new rule was proposed. The pattern of rule, rescission reproposal has continued for over a decade, each cycle documented in thousands of pages of administrative record. The industry's lobbying expenditures during this period were also documented in FISA filings.
The payday lending documents showed that legal disclosure can be technically compliant and functionally deceptive simultaneously. The 391% APR was in the paperwork. Nobody hid it. The system was designed so that the people who most needed to understand it were least equipped to do so and had the fewest alternatives. The paper trail exists in the loan agreements, the rollover records, the internal analytics. It's been read by regulators for 20 years. Subscribe for more cases.